Here's a detailed summary of Morgan Stanley's 2025 Q4 earnings call, focusing on key financial metrics, management's outlook, risks, and important statements from leadership, overall performance, and key financial metrics. 2025 fiscal year and Q4 record revenues. Morgan Stanley achieved record full-year revenues of $70.6 billion, with fourth-quarter revenues reaching $17.9 billion. Earnings per share, EPS. Full-year EPS was a record $10.21. Q4 EPS was $2.68. Return on tangible common equity, ROTCE. Full-year ROTCE stood at 21.6%, and Q4 ROTCE was 21.8%. Efficiency ratio. The firm's full-year efficiency ratio improved to 68.4%, indicating disciplined execution and investment prioritization. Total client assets ended the year at $9.3 trillion. Wealth management margins achieved a record 29% pre-tax margin for the full year, with Q4 reaching 31%, 31.4% reported. Institutional securities shared gains gained 100 basis points of wallet share in investment banking and markets. Business segment highlights. Institutional securities delivered record full-year revenue of $33.1 billion, $7.9 billion in Q4. Investment banking, full-year revenue of $7.6 billion, with Q4 at $2.4 billion, up 47% YOY, driven by record debt underwriting and strong advisory results. Pipelines for 2026 remain healthy. Equities, record full-year revenue of $15.6 billion, $3.7 billion in Q4, with gains driven by client engagement and risk management. Prime brokerage and cash equities showed strength. Fixed income, full-year revenue of $8.7 billion, $1.8 billion in Q4. While micro and macro results declined due to lower volatility, investments in lending contributed to consistency. Wealth management delivered full-year records with $31.8 billion in revenue and 29% margins. Net new assets, $356 billion for the full year, with $122 billion in Q4. Fee-based flows, $160 billion for the full year, marking the third consecutive quarter exceeding $40 billion. Advisor-led assets accelerated to a record $99 billion originating from workplace and E*TRADE. Bank lending balances grew to $181 billion, driven by securities-based lending and mortgages. Net interest income, NI, increased to $2.1 billion in Q4. Investment management assets under management, AUM, scaled to a record $1.9 trillion. Management fee revenues reached all-time highs. Net flows, 6 consecutive quarters of positive long-term net flows, totaling $34 billion for the full year. Liquidity and overlay services saw $68 billion in inflows in Q4. Management's forecasts and outlook for future quarters. 2026 continued tailwinds and headwinds. Management expects the mix of macroeconomic and geopolitical tailwinds and headwinds to prevail in 2026. Higher plane of operating performance. The firm aims for a higher sustained level of operating performance through the economic cycle, compounding earnings in a capital-efficient way. Execution from strength. Morgan Stanley enters 2026 from a position of strength, with strong client momentum, management stability, and growing capital excess. Wealth management NI expected to remain roughly flat quarter-over-quarter in Q1 2026, with a trend higher for the remainder of the year, assuming current forward curves, incremental loan growth, and deposit mix. Investment banking pipelines remain healthy and diversified, with accelerating strategic activity and potential for IPO market reopening. Institutional securities, well-positioned for the global investment banking and capital markets cycle in 2026 and beyond due to share gains. Tax rate expected to be between 22 to 23% for 2026. Significant risk factors: geopolitical swirl and ambulant markets. Management explicitly cited ongoing global uncertainties and their potential impact on the business. Higher asset prices. Caution was advised regarding potential overreach in the face of elevated asset prices. Macroeconomic volatility. While the macro backdrop is seen as generally constructive, the potential for risk-off periods due to economic blips or geopolitical events remains a consideration, which could impact trading revenue. Teething pain with AI implementation. While AI presents significant opportunities, management acknowledged potential teething pains in integrating new technologies, understanding language models, regulatory interactions, and client adoption. Key highlights: durable performance. The firm's ability to deliver consistent results across various market conditions over the last 8 quarters was emphasized. Integrated firm strategy. The success of the integrated model, combining wealth management, institutional securities, and investment management, was a recurring theme. Wealth management scale and performance. The thriving nature of all 3 wealth channels, financial advisors, workplace, E-Trade, and record margins were significant achievements. Institutional securities share gains, demonstrating successful execution of the strategy to gain wallet share in a competitive environment. AI adoption. Increasing confidence in the efficiency and effectiveness of AI technologies across business units and infrastructure. Global footprint. Significant revenue growth in EMEA and Asia highlights the importance of their international presence. Capital strength and return. High capital levels, 15% CET1 ratio, over 300 basis points excess capital, and consistent dividend growth demonstrate financial discipline. Strategic acquisitions and investments. The integration of past acquisitions, Smith Barney, Solium, E-Trade, Eaton Vance, and recent strategic moves, Equities in, Carta Partnership, Zero Hash, were highlighted as foundational for future growth. Lowlights. Micro and macro results decline. Fixed income micro and macro results declined YoY in Q4 due to lower volatility in FX and weaker credit performance. Commodities also saw a decline due to lower power and gas revenues. DCP impact on wealth margin. Discretionary compensation plan, DCP, negatively impacted the Q4 wealth margin by 95 basis points, though management is transitioning hedges to reduce accounting volatility. Most important statements from CEO, Ted Pick, and CFO, Sharon Yeshua. CEO, Ted Pick. Economic resilience and tailwinds. In 2025, the U.S. economy proved resilient as ever. 2026 starts with the tailwinds of constructive fiscal policy and easier monetary policy. Higher plane of operating performance. The longer-term cadence we seek is a higher plane of operating performance through the cycle as we compound earnings in a capital-efficient way. Reason for not raising targets. We have 8 quarters where we've been able to see performance driven by the 2 major segments separately and then together. It is the case, though, that with the compounding of earnings and the continued growth of these businesses, it is quite possible that we are going to be moving right through these firm-wide goals. But I think no mistakes that I'll make, Glenn, this won't be one of them, which is to kind of hit the new target slide at the beginning of, year 3 because we're feeling our oats. I think we have a very positive view of where the firm is positioned. But I think the view is we're a couple years in. Each of the quarters has been by many measures quite excellent. And the 2 years taken together, also excellent. But I think no mistakes that I'll make, Glenn, this won't be one of them. Investment banking 3rd inning. I think in the capital markets business as a whole, I kind of put us in the 3rd inning. AI opportunities. The need for capital markets and structuring expertise in terms of what's going on within the AI ecosystem is clearly there. CFO Sharon Yeshua. 2025 was an exceptional year for the firm, marked by deliberate execution of our strategy. Record full-year and Q4 results. Full-year revenues reached a record of $70.6 billion, and the fourth quarter revenues were $17.9 billion. Our ROTCE was 21.6%, and we generated record EPS of $10.21 for the full year, alongside fourth quarter ROTCE and EPS of 21.8% and $2.68, respectively. Wealth management margin drivers. I think it's both. We have consistently added fee-based flows. That is demonstration that the funnel is working. There are also clients who just want self-directed activity, and we have been investing in that business. And the second piece that you mentioned is efficiency. We are also using technology to help us from an efficiency perspective both on the cost and the revenue side. DCP transition. Over the course of the first quarter, we will be transitioning all economic hedges for DCP obligations to derivative instruments. We are making these changes to reduce the accounting-driven volatility in revenues and earnings. International strength. When we bought Eaton Vance, one of the premises was they had a franchise that was basically very U.S.-driven from a distribution perspective. We are in a position where we are seeing, for example, our fixed income flows over the course of this quarter. 50% of that distribution was coming from international accounts. This summary provides a comprehensive overview of Morgan Stanley's 2025 Q4 earnings call, capturing the key financial details, strategic direction, and management's perspective on the firm's performance and future outlook.